Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about NETSKOPE Inc. Annual Report. NETSKOPE Inc. offers a wide range of businesses and services that cater to the security needs of enterprises worldwide. At its core, the company provides security solutions through its NETSKOPE One platform, which includes various products such as Cloud Inline Security, Cloud Access Security Broker, Data Loss Prevention, Threat Protection, and Secure Web Gateway. In addition to these security products, NETSKOPE also offers networking solutions that enhance performance, resilience, connectivity, and security. These include Firewall as a Service, Internet of Things/Operational Technology Intelligence, Software-Defined Wide Area Network, Dedicated Egress IP, and Cloud Packet Stream solutions. Furthermore, the company provides analytics solutions that enable enterprises to gain insights into user activity, data movement, and security events across various environments. This includes advanced analytics, user and entity behavior analytics, data lineage, and digital experience management. Overall, NETSKOPE's comprehensive suite of businesses and services helps protect human users, non-human entities, and data from cyber threats through the use of zero-trust principles. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth or decline can be identified through an analysis of financial reports and documents. Revenue growth is often driven by subscription revenue, professional services revenue, hardware sales, and revenues related to managed service providers, MSPs. On the other hand, revenue decline is typically attributed to a decrease in accounts receivable, which improves operating cash flows, as well as an increase in accrued compensation and benefits, accounts payable, and accrued expenses and other current liabilities. Regional analysis reveals that the Americas region experienced significant growth, with revenue increasing from $246 million in 2024 to $400 million in 2026. Deferred revenue also saw a substantial increase of $239 million between 2025 and 2026. Furthermore, remaining performance obligations represent a contracted future revenue of $1.2 billion, with 54% expected to be recognized within the next 12 months. The amortization expense for developed technology is another key factor in understanding revenue growth or decline. For instance, the amortization expense included in cost of revenue was $15.8 million in 2026 and is projected to be around $13.6 million from 2027 to 2031. These figures highlight the importance of considering various financial metrics when analyzing revenue growth or decline. Net income has been on a downward trend over the past 3 fiscal years. In fiscal 2026, the company reported a net loss of $679.4 million, compared to a loss of $354.5 million in fiscal 2025 and $344.9 million in fiscal 2024. This significant decline in net income is attributed to various factors, including pricing pressure, decrease in gross margins, increase in operating expenses, increased competition, and economic conditions. Profit margins have also been affected by these changes. While the company's gross margin remained relatively stable at 68% in 2026 and 65% in 2025, its non-GAAP gross margin saw a significant increase from 65% to 75% over the same period. However, this improvement was not enough to offset the decline in net income due to other factors such as price reductions, reduced revenue and gross margins, increased costs of labor and shipping, weakening exchange rates, and reduced customer demand for platform and products. The company's accumulated deficit has grown significantly, reaching $2.6 billion as of January 31, 2026. This suggests that the company is struggling to maintain profitability and may need to make significant changes to its business strategy in order to turn things around. The company's financial performance indicates a strong ability to generate positive operating cash flow. One key indicator of this is the expectation that existing cash will meet its needs for the next 12 months, as stated on page 61. This suggests that the company has sufficient cash generation to cover its expenses. Further evidence of positive operating cash flow can be seen in the net cash provided by operating activities, which was $38,000 and $73,000 in 2026, page 78. Additionally, the fourth quarter of fiscal 2025 and all quarters of fiscal 2026 showed positive operating cash flow. The company's financing activities also contributed to its overall positive operating cash flow, with a net cash provided by financing activities of $895.4 million for fiscal 2026. Overall, these indicators demonstrate that the company is generating sufficient cash from its operations to meet its needs and cover its expenses, resulting in positive operating cash flow. The company's debt level has undergone significant changes over the past few years. Initially, total liabilities increased from $1,344,095 to $1,577,761 between two unspecified dates. However, when looking at a longer time frame, we see that total debt rose from $420,280,000 in January 2023 to $720,960 by January 2026. This increase is partly attributed to the issuance of $1,000 principal amount of 2029 notes. On the other hand, interest expenses have shown mixed results. In one instance, interest expenses decreased from $5 in 2025 to $0 in 2026. However, there was a significant increase in interest expenses due to an accrual rate of 3% per annum. Furthermore, PIK, pay in kind, interest expense for the 2028 notes increased from $15.9 million in 2025 to $16.5 million in 2026, while for the 2029 notes it rose from $0.8 million in 2025 to $2.3 million in 2026. The performance of various regions and segments has been a mixed bag. On the positive side, EMEA and APJ have shown impressive growth, contributing significantly to the company's revenue. EMEA accounted for 25% of revenue, with a remarkable 36% year-over-year growth, while APJ contributed 19% of revenue, with a notable 30% year-over-year growth. However, there are regions that pose potential issues. The global market, international markets, and the U.S. face disruptions and delays due to geopolitical risks in China and Taiwan. These challenges may impact business operations and revenue growth in these areas. Management is optimistic about the company's future prospects, driven by growing demand for its platform in the security and networking solutions market. To capitalize on this trend, they plan to invest heavily in sales and marketing efforts both domestically and internationally. This investment will be complemented by research and development initiatives aimed at driving innovation and strengthening the company's technology leadership. In terms of profitability, management is focused on retaining and growing revenue from existing customers through customer success and loyalty programs. They also aim to continuously innovate their platform to drive growth and improve profitability over time. While sales and marketing expenses are expected to increase in the short term, they will decrease as a percentage of revenue over the long term. The company's cash flow is also expected to improve significantly over the long term, driven by operational efficiencies, scale benefits, and technological advancements. Management is taking steps to manage foreign currency risk through various hedging strategies. Finally, the company may seek additional capital resources in the form of equity or debt financing to execute strategic initiatives aimed at driving growth. Overall, management's strategy appears to be focused on driving growth through investment in sales and marketing, research and development, and customer success, while also managing costs and improving cash flow. The company's financial policies have been focused on retaining earnings rather than distributing them to shareholders. One key aspect of this policy is the decision not to pay dividends, as stated in multiple sections of the report. This suggests that management believes it is more beneficial for the company to reinvest its profits and drive growth through internal means. On the other hand, the company has been actively engaging in share buybacks through stock options and restricted stock units, RSUs, granted to employees and certain non-employee directors and business partners. This indicates a desire to reduce the outstanding share count and potentially boost earnings per share, while also providing incentives for key stakeholders. That concludes the financial summary for NETSKOPE Inc. Feel free to comment below, and I will be happy to answer them when possible.